Today we're going to be talking about private debt funds. If you own any or you're thinking about buying any, you're going to want to watch this video. My name is Michael LeBlanc and this is Mike on Money. As always, these videos are for educational purposes only. Always do your own due diligence, or better yet, reach out to us. We're happy to do a portfolio, no obligation portfolio review for you. Take a deep dive into what you currently hold or what you're thinking about buying, and give you a review. And I think you're really going to want to know more about the debt funds if you do currently hold some and what potential risk you're facing. So let's do a breakdown of what these are. Canadians are traditionally very hungry for yield, and they've been drawn to these funds over the last 5 years. The promises of 8 to 12% return have attracted investors, but a lot of them don't really know what they own. In fact, I would argue that a lot of their advisors might not know exactly what they own, and we're going to dive into why that is. So let's back up a little bit and talk about where these things came from and what the main concerns are. And when I say concern, I mean this is probably my most the area of investing in Canada today that I think carries the greatest risk for investors. Not that they're the riskiest investments out there, but the lack of understanding of how they're structured and what risk investors actually face is a big unknown for many people out there. We can break down the math, the part of the risk in simple math. So if you think about debt, and that's what these things are, they are debt. You're buying or you're lending your money out to borrowers. And if you think about debt today, and we just use the benchmark of the 5-year mortgage rates, saying your average person out there can go borrow money against a secured asset like a house, it's ranging between 5 and 6%. Even if you look at car loans, and here's a depreciating asset, 7 to 9%, and unsecured line of credits are about 9%. So if you take that into account as a benchmark of what the rates are paying there, these funds are out promising 8 to 12%. So that's higher than those kind of average benchmarks. And they're telling people that these are secured, low risk, low debt to equity ratios, meaning that there's more value in what the assets it's secured to than the loans. How are they getting that 8 to 12% after fees? Because remember, the fund itself has built-in fees. We'll talk about the fee structure a little bit later on, but they can be anywhere from 1.5% or 1% at least to 3-4%, depending on the structure that you're in. So just simple math, if we look at these funds, the returns don't make sense. So let's talk about that risk and how we can better protect yourself or better inform yourself about what you own. Now, I'll start by saying I don't believe all private debt funds are low quality. They all inherently have fundamental risks that you might not be aware of because of their structure. I don't think that all the different fund managers or fund companies out there are out there doing a bad job. A lot of them are trying to do a really good job in a very unique market, very niche market, and that's part of the problem. And let's start about where these structures originally came from, what brought them to popularity in the last 5 years. So if we look back, private debt's been around for a very long time. It traditionally was in an institutional product or a sophisticated investor product called offerendum memorandum, short form OM. So these things were only available to institutions or accredited investors, so people who had more than $1 million to invest in and could accept risk. And they weren't meant to ever be all of someone's portfolios. They represented a small piece. Even if you look at the rule of thumb of traditional portfolio management, generally accepted practices is these things should represent about 20% of your portfolio at most. That's kind of the top end of the general practices. So these things originally, this OM product, it was for institutional, it was for very sophisticated investors, where liquidity wasn't a big concern. So people who put money in, that money would be lent out. They would get, the yield or the distributions back again. And if anything went wrong, and there was a problem in that loan portfolio, and the managers had to, in simplest terms, repossess the property to get the money back, that process can take 3 to 5 years, in which case the fund isn't liquid. But those types of investors, institutionals, pensions, high net worth people who have parked, a small piece of their investments in that area, they could wait it out. They would wait. They would get their return after the asset is liquidated, and the loan is paid back. And the managers who worked in that that high quality area, they did their own due diligence on who the money was being lent to, the quality of the property, the quality of the asset, any other lenders out there, like what rank they might fall in if there was a liquidation of the property. There was a lot of work and due diligence put into it, and it was very high quality. Now, another structure out there that's been around a long time, especially in residential mortgages, is a MIC corporation, or mortgage income corporation. These generally take form of a preferred share. Now, these aren't as common. They've been out there as where you buy a preferred share, and your preferred share pays you a dividend from the returns of those loans or those mortgages. Now, a lot of people say that one's better, but you're going to run into all the same problems. And I'll tell you one thing they won't tell you is that if they ever have to change the structure of those loans, like how it's being paid out, or when it gets paid out, or if there's a hold on the payouts, you're a preferred share, and preferred share does not have a vote. So that means any changes can be put through without any of the shareholders' consent or agreement. Because you don't have a vote as a preferred shareholder, it falls back to your general partners. They get to decide what happens to those funds. Now, the real thing that's driven this market for the last 5 years is back in 2018, hedge funds and fund companies lobbied basically the regulators to take hedge funds, which were under that OM, that off-random or institutional type packaging, over into the retail market, or available to all investors. And they got that change put through under the umbrella of what's called liquid alternatives, or liquid alts. So liquid alts are basically those OM products that were only available to the sophisticated and high net worth for a reason, because they carried a lot of different risk. They got moved into the retail arena, meaning anyone could buy it. Now, they name these things liquid alts because they had to bring some liquidity, because OMs are often long-term investments. They can have, only annual liquidity, sometimes 5-year liquidities. You couldn't get your money out on a daily basis like you can with mutual funds or ETFs on the markets. So they came out with liquid alts, and they got this moniker because you did have liquidity. Whether daily liquidity, weekly liquidity, sometimes monthly, sometimes quarterly, so every 90 days. So they came out with these funds, and they repackaged hedge funds as alt funds, and what came under that umbrella as well is these private debt funds. They came under the alternative category, and they were able to be sold to everybody. And that's when all the promotions started about this 8 to 12% return, 8 to 12% yields, and that attracted a lot of investors because why not? I can get 8 to 12%. It sounds super safe, and if you're getting that type of returns from your portfolio, especially if you're looking for income, great. A lot of people moved into there. Now, the problem is, if you think back in 2018, I already gave you the math of today of how do you get 8 to 12% off a quality lending portfolio or private debt portfolio. How did they do it back in 2018 when rates were half that? And the answer to that is they took risk. So we saw this booming market. We saw money flooding into there. And a big problem with money flooding into fund structures is those funds, in order to meet those distributions, in order to give you that return, they have to get that money invested. So if you had a small niche market that was largely occupied by institutional money, and all of a sudden you have all this capital flowing in there. There's only so many quality borrows out there, so fund companies had to place that money quickly, and by doing so, they degraded the quality of their loan books. Right? They put more and more with less and less quality loans to keep up that distribution level, and also to place the capital as it flowed in. And what we saw, we saw a lot of problems. We saw bad actors. An example of bridge financing, and a lot of people will defend their portfolio and say, "Hey, our private debt is really good quality. Bridging is a bad example because it was fraud," and that's true. Bridging has been in courts basically for the last 4 years. Investors are still trying to get their money, and it's been proven that there was fraud. There was outright money laundering, or not money laundering, but embezzlement being taken out of the portfolios, kind of leaving investors with, sounds like, maybe 20 cents on the dollar that they put in. And in the meantime, in the last 4 years, they've got no distributions and there's no liquidity, so they got completely shut down. Now, there was other ones out there. Romspen and Hazelview and Purpose Fund all had a private debt fund. Romspen and Hazelview completely shut down liquidity. They weren't frauds. They just couldn't meet liquidity demands. And after they started selling off their loans or liquidating their loans to give liquidity to investors, of course, that cut into yield, so they had to stop paying out distributions. So those two, again, long-term, 3 to 5 years to get the money out, and in the meantime get no distributions. Purpose Investment, another OM, high quality, or they will claim high quality, that had 30%, 25 to 30% drop in the asset value of the portfolio due to bad loans in 1 year. Cut their distributions from the promised or the represented 8+% down to 6+%. And meantime, there was no liquidity for 5 years. So investors were stuck in there for 5 years. They're not getting their 8.5 anymore, or roughly 8.5. They were down to just below 6%. Plus, they were only getting that 6+% on a portfolio reduced by about 25% as it experienced loan loss in the first couple of years of it launching. Another high quality fund out there, this is an alt fund. This is a liquid alt fund, 9 Point Funds. Recently closed redemptions, so you can't get your money out. You can't even get your distributions out on the monthly distributions out in cash anymore. You have to reinvest it back into more shares. Basically locking up more of your capital as time goes on. And they also took roughly a 30% write down due to bad loans in one of their loan portfolios. A Toronto property, again, it looked like a good investment. It was a Toronto property called One Bloor West that was being built. It collapsed. The initial holders were in China. There was no way to go back and try to recoup the money from them, and they had to take a write down on that fund as well. These are just a few examples of what were held out as good quality. They had long-standing track records that failed. Now, I'll go back to my initial comment. I don't think all these funds are bad, but now we're going to talk a bit more about the structure and where those risks lies. So let's take a break for a second.